setting the frame. If you've ever watched the markets move and thought, how do professionals trade this with confidence while most people struggle? This video is for you. Futures trading is one of the most powerful financial tools in the world. It's used by banks, hedge funds, institutions, and professional traders every single day. Yet, for many retail traders, futures feel confusing, intimidating, or even dangerous. And the truth is, futures are dangerous when you don't understand them. But when you do understand them, futures offer something very few markets can: clarity, efficiency, transparency, and opportunity. In this video, I'm going to explain futures trading the way professionals actually think about it. No hype, no shortcuts, no get-rich-quick nonsense. By the end of this lesson, you'll understand what futures really are, why professionals prefer them, how money actually moves in futures markets, and what separates consistent traders from everyone else. Let's start at the foundation. What futures contracts really are. At its core, a futures contract is a standardized agreement to buy or sell an asset at a specific price for delivery at a specific time in the future. That's it. You are not buying shares of a company. You are not investing long-term. You are trading price movement. These contracts trade on regulated exchanges like the CME, the Chicago Mercantile Exchange, which means pricing is transparent, centralized, and fair. Let's use a simple example. The E-mini S&P 500 futures contract, often called ES, represents the value of the S&P 500 index. When ES moves 1 point, that move is worth $50 per contract. If ES moves up 10 points, one contract makes $500. If it moves down 10 points, one contract loses $500. Every futures contract has a tick size, the smallest price movement, a tick value, how much that movement is worth, and a contract value that defines risk and reward. This is important because futures trading is mathematical. There's no guessing what your profit or loss could be. Professionals like this because risk is defined, execution is precise, and position sizing is clean. Another critical difference: futures contracts expire. They are not permanent instruments. Each contract has a life cycle. Professionals trade the most liquid contract, usually called the front month, and roll forward as volume shifts. This keeps markets efficient and prevents manipulation. Why futures markets exist? Futures were not created for speculation. They were created for risk management. Originally, farmers and producers used futures to lock in prices ahead of time. This protected them from unpredictable price swings. Over time, institutions realized futures could also be used to hedge portfolios, express macroeconomic views, and deploy capital efficiently. Speculators, traders like us, provide liquidity. Without speculators, markets don't function smoothly. This creates a balance. Hedgers reduce risk, speculators seek opportunity, institutions move size, market makers maintain flow. This balance is why futures markets are some of the most liquid markets in the world, and liquidity matters. Liquidity means tight spreads, fast fills, minimal manipulation. Professionals don't want markets that can move. They want markets that move cleanly. Why professionals choose futures? There's a reason prop firms, hedge funds, and full-time traders love futures. First, leverage. Futures allow capital efficiency. You don't need to put up full contract value, only margin. But here's the professional mindset shift. Leverage is not used to gamble. It's used to control risk precisely. Second, no PDT rule. You can day trade freely with small accounts. Third, nearly 24-hour trading. This allows flexibility and global participation. Fourth, clean price action. Futures markets respond directly to order flow, volume, and liquidity, not hype or headlines alone. And finally, Regulation and transparency. Futures exchanges are heavily regulated. Prices are centralized. There's no dark pool guessing game. Professionals don't want mystery. They want clarity. How price actually moves. This is where many traders get lost. Price does not move because of indicators. Price moves because orders are executed. Every candle on your chart represents buyers willing to pay higher prices, sellers willing to accept lower prices. When buyers become aggressive, price moves up. When sellers overwhelm buyers, price moves down. Professionals ask one question: where is liquidity likely to be taken next? Highs and lows attract orders. Breakouts trigger stops. Failed moves trap traders. Understanding this changes everything. You stop predicting. You start reacting. The biggest mistake beginners make. Most beginners focus on indicators, signals entries. Professionals focus on risk execution. Consistency. Futures are not forgiving. One oversized position can erase weeks of progress. This is why professional traders think in terms of risk per trade, daily loss limits, maximum contracts. The goal is not to win big. The goal is to stay in the game, the professional path. Futures trading is not about being right. It's about managing risk, executing with discipline, and thinking in probabilities. If you treat futures like a casino, they will destroy you. If you treat them like a business, they can change your life. This course is designed to teach you how professionals actually trade, not what social media sells. In the next lesson, we'll break down how futures markets are structured and who really moves price. Because once you understand that, you stop fighting the market and start trading with it. I'll see you in the next video.